Welcome, my winners. This is KevinhTeaches. This is my macroeconomics series. Economic series. This is part 1.2, section 1.2. This is going to be covering microeconomics and macroeconomics. And we're just going to talk about a little bit of the difference. So, our learning objectives today is one, describe macro, man, can I spell today? And describe macro, and pretty much talking about the difference between both of them. And lastly, monetary policy P versus fiscal policy P. Boom. So we're just going to learn about these three things over the video, and so let's get right into it. And first and foremost is our first definition. Our first term is microeconomics. You could be asking, why are we learning all about microeconomics and macroeconomics? And so we're just going to cover the terms and just understand there is a difference between microeconomics and macroeconomics. So the definition of it, let me get that out for you. The definition is just pretty much the study of individuals who need to make decisions. Let me get that over here. Study of individuals who need to make decisions within the economy. Think of these for your example. Oh, let me get that there. Examples are things like households, your mom and dad. They have to figure out what they should buy with their scarce amount of money. Workers are also a type where you have to place each worker in a certain area, and we gotta maximize their time. And businesses are also a thing we would study within microeconomics. Notice how all of these are just one person or one thing or one company. And this is what microeconomics is all about, the small scale, the micro version of it. And so the difference between that and macroeconomics is that, as the names would imply, is that macroeconomics is a lot about the bigger idea. And the big idea for the definition is, let me get this out for you, is that when you look at the company as a whole, it's kind of like all this. Oh, let me cut that up for you. Oh, looks like it's not cutting up properly. Boom, boom, and boom. So this is kind of the definition. It's a long definition, but you can summarize it in your own notes. It's just simply like when you look at the economy, like the big economy, the huge economy, we're focusing on big issues such as, growth production. You've heard of this in your, the news, such as how are we growing today? GDP growth and unemployment. That's all about macroeconomics. And inflation and government deficits and exports and imports. And some of the reasons why people like studying macroeconomics more than microeconomics is that people hear about it all the time. Like in the news you'll see, oh, inflation's up this X amount of numbers, or employment is at this lowest in 20 decades or whatever. And so macroeconomics is covering everything. And when you contrast it with micro, small, and big, you see that there's a huge difference. And they're not different subjects, they just cover different topics. Alright, now that we've learned micro and macroeconomics, let's move on to our little intermission today, which is, before we cover our next topic, is going to be all about the Federal Reserve. The Federal Reserve. So what is the Federal Reserve? Often the Federal Reserve is just known as the Fed. The Fed. And now they're just huge big banks. They're just big banks for the United States. Yay, for the United States, Now, they aren't the Bank of the United States. You can't open a checking account at here, so I can't go in and ask for a checking account. I can't because it's only for government institutions. Um, More broadly, it was. Oh, let me get my notes out of here for you. More broadly, it was created in 1923, 1913, sorry, by President Woodrow, who was like, "Hey, we need something to figure out like if we need money or we need to ask international places, like France, Spain, and during this time for money. This is gonna be our little agency that does it for us." And they have four responsibilities within them. Four responsibilities of the Federal Reserve abilities. Number one is they're really all, firstly and foremost, going to be like creating policies. Creating policies to help the economy. Help the economy. If you have ever heard of the interest rates, like, oh, we're setting the interest rates. Who is setting the interest rates? That's the Federal Reserve right here. They are setting the interest rates. And we'll talk later within the series about why, like, how does that happen, and like, why does it affect the economy? Like, how does it affect it? Point number two, they really supervise the big banks, all other banks. They really are like the governing authority for all the other banks. So, all these smaller ones, and they go to regional ones, big ones, and then they go to the Federal Reserve, the Fed. They answer to the Fed. So whatever the Federal Reserve wants other banks to be doing, they will make them do it. It's kind of like a big brother kind of thing, but it protects all of us. And number three, maintaining stability. So making sure we don't go too far deep. Stability, and making sure that if we ever go, if our economy looks like this, and we go, wee, the Federal Reserve is going to say, hold up, wait a minute, stop. We're going to go flatline, then we're going to go back up. And this is a simplified version, but that's basically how they want to make sure. If you remember 2008, there was a huge recession, and the Federal Reserve had to make a huge role in stopping it from um, getting worse, and so they took a lot of action. And eventually, we got to here. And then lastly, they interact with international international entities. Entities. Think of Spain, like England, or you can say the United Kingdom in this example, and just other countries. What's actually really interesting is that within the United States, there's a huge amount of our money is being held elsewhere, and that's because the Federal Reserve is selling bonds, selling other countries like loans, so we can get money right now, and so these other countries can hold securities for us. So we talked current. Now that we've covered pretty much what Federal Reserve is, what all of those do, what are their policies? And this moves on to our next topic, our next definition. Moving up, our first definition is pretty much monetary policy versus fiscal policy. Policy. So what's the difference? Let's first touch on monetary policy. Monetary policy is what the Fed does. The Federal Reserve. Think money, and the Federal Reserve, which is a bank. So this is kind of how you remember monetary policy. Who handles the money? It's the Federal Reserve. They handle the money. They are the big bucks here. And so what's the definition? The definition basically is simply is that it's which involve policies that affect bank lending, interest rates, and financial markets. Let me cut that up for you. Here we go. Which involves policies that affect bank lending, interest rates, and financial capital markets. We'll touch all of these at a later date, but it's just understanding that what can a bank do? A bank can lend money, a bank can set interest rates, and a bank, handles capital markets, such as like loans, bonds, etc., etc. So when you think monetary policy, think of banks. What can banks do? Bank lending, setting interest rates, and financial capital markets. Okay, now that we understand that, what is the difference between that and fiscal policy? I'll write it in red just to make sure we understand there's a lot of difference between both of them. Fiscal policy. Fiscal policy. And so the difference between fiscal policy is that unlike banks that set the policy, it's the government that sets the policy. So definition. The definition is simply is which like it's the legislative branch, Congress. They set the policy for this. Ding ding boom boom boom. Which involves the government spending and taxes for the United States. This is pretty much Congress and the executive branch, which originates the federal budgets. So things like this, think of like what can Congress do versus what can banks do. What the Congress can do is talk about government spending. Do we want to spend more on things like military spending, etc.? And we can set things like taxes. Taxes are huge, huge within our economy, and they play a big, big role. And so when we think of Congress, we should think fiscal policy, fiscal policy. And the real way, like, to remember this stuff is just think of fiscal as a very proper name for money. So what is very proper in the government? It's Congress. They're very, very old-fashioned, very proper, very respectful. So we should think of Congress equals fiscal policy. Alright, so now we've pretty much learned that. Let's just overview one more time what we've learned today in this video. First, we learned about micro and macroeconomics and what's the difference between them. Microeconomics is the study of smaller things such as households, workers, and individuals. Macroeconomics is all about the big number, the big picture, inflation, GDP, etc. We talked about the Federal Reserve and what the bank kind of does with these poorly drawn pictures. And we talked about the responsibilities. And then last, we talked about monetary policy versus fiscal policy, and which is pretty much the difference. Monetary policy, money, banking, they do all the interest rates and what banks do. Fiscal policy, fiscal, very proper. This is all about Congress. And so they just set fiscal policy through military spending, government spending, and taxes. And thank you so much.